I never chase trends. I never buy what's hot. And I've certainly never touched Bitcoin. But let me tell you something that might surprise you. As Bitcoin collapses, as the entire cryptocurrency fantasy unravels, as millions of people watch their wealth evaporate, I'm not celebrating. I'm not gloating. What I am doing is the same thing I've done every single day for the past 70 years. I'm looking for productive assets trading at reasonable prices. I'm evaluating businesses. I'm thinking about value. I'm focusing on what actually works. The collapse of Bitcoin doesn't change my investment approach one bit. It never would have. Whether Bitcoin trades at $100 or $100,000 or $10 has absolutely zero impact on what I buy, because Bitcoin was never a real alternative to productive assets. It was never a competing investment option. It was noise, pure noise, a massive distraction that pulled billions of dollars and countless hours away from real wealth creation and into pure speculation. And now that the noise is finally quieting down, now that reality is reasserting itself, people are asking me what they should buy instead. The answer is the same as it's always been. The same answer I would have given 50 years ago. The same answer I'll give 50 years from now if I'm somehow still around. Buy productive assets. Assets that create value. Assets that generate cash flows. Assets that work for you rather than requiring you to find someone willing to pay more than you did. I'm going to tell you about 3 types of assets I'd buy right now. Not because Bitcoin is collapsing, though that certainly makes the conversation more relevant, but because these 3 asset types have always made sense. They made sense when I was starting out in the 1950s. They made sense during the dot-com bubble. They made sense during the housing crisis. They make sense now. And they'll make sense long after cryptocurrency is a forgotten footnote in financial history. But before I get specific about those 3 assets, I need to talk about principles, because recommendations without understanding are worthless. If I just tell you what to buy and you follow blindly, you're no better off than the people who bought Bitcoin because some influencer told them it was the future. You need to understand why certain assets create wealth, what characteristics make something worth owning, how to evaluate opportunities independently, how to think for yourself. This is what separates real investors from speculators. Real investors have principles. They understand what creates value. They can analyze opportunities using frameworks that work across different assets and different time periods. Speculators follow tips. They chase momentum. They buy what's going up and sell what's going down. They confuse price movements with value creation, and over time, consistently, reliably, they lose money. So let's start with the fundamental question: what makes an asset worth owning? The answer is simple but profound. An asset worth owning produces something of value. It generates cash flows. It creates wealth that didn't exist before. The asset works. It does something. It serves customers, houses, tenants, grows crops, manufactures products, provides services. The value creation is real, tangible, and ongoing. When you own a farm, that farm produces crops every season. The corn grows, the wheat ripens, the soybeans mature, you harvest and sell them. That's value creation. The farm took sunlight, water, and soil and converted them into food. Something valuable that didn't exist before now exists, and you, as the owner, receive the economic benefit of that creation. When you own an apartment building, that building houses tenants. Those tenants need a place to live. They willingly pay rent for that shelter. Every month, rent checks arrive. That rental income is real value creation. You provided something people need, and they compensate you for it. The building itself doesn't just sit there. It serves a function. It creates value by meeting a human need. When you own a business, that business serves customers. It creates products or provides services that customers willingly pay for. Every transaction represents value creation. The customer believes what they're receiving is worth more than the money they're paying. The business believes the money received is worth more than the cost of providing the product or service. Both parties benefit. value is created, and you, as an owner of the business, share in that value creation through your proportional ownership. This is the essence of real investing. You own something that produces, that creates, that generates cash flows from genuine economic activity. Your returns don't depend on finding someone to pay more for your asset than you paid. Your returns come from the asset itself, from what it does, from the value it creates year after year after year. Now compare this to Bitcoin. What did Bitcoin produce? Nothing. What cash flows did it generate? None. What value did it create? Zero. Bitcoin just sat there in digital wallets doing absolutely nothing except existing. The only way to make money from Bitcoin was to sell it to someone else for more than you paid. That's not investing. That's speculation. That's a game of musical chairs. And when the music stops, when the supply of new buyers dries up, the people left holding Bitcoin discover they're holding nothing of substance. This fundamental difference between productive assets and speculative tokens is why I never touched Bitcoin. It's why I call it rat poison. It's why I warned people constantly that cryptocurrency was a delusion, not because I'm afraid of technology, not because I'm too old to understand innovation, but because I understand what creates wealth. And Bitcoin didn't create wealth. It just redistributed it from late buyers to early buyers. That's not investment. That's a transfer scheme. But here's the thing that really troubles me about the cryptocurrency phenomena. It wasn't just that people speculated in Bitcoin. People have always speculated. They bet on horse races, play the lottery, go to casinos. Speculation is as old as humanity. What troubled me about cryptocurrency was that it was presented as investing. It was marketed as a legitimate alternative to stocks, bonds, and real estate. Young people were taught that buying Bitcoin was building their financial future, that holding cryptocurrency was how you created wealth in the modern era. This lie, this fundamental misrepresentation of what investing actually is, damaged an entire generation. Millions of people spent years thinking they were investors when they were actually speculators. They thought they were being financially responsible when they were actually gambling. They thought they were securing their future when they were actually betting everything on a collective delusion. And now that delusion is collapsing, and those millions of people are learning the hard way what real investing actually requires. The lesson, painful as it is, might be the most valuable thing to come out of the cryptocurrency disaster. Because if people learn to distinguish between productive assets and speculative tokens, if they learn to demand cash flows and value creation, if they learn that price and value are different things, then they'll become real investors. They'll stop chasing trends. They'll stop following crowds. They'll start thinking independently, and they'll build real wealth over time. That's my hope as I watch Bitcoin collapse. Not that people suffer, but that they learn, that they emerge from this experience with better understanding and sounder principles, that they redirect their energy and capital toward productive investments, that they build their financial futures on foundations that actually work rather than hoping speculation will somehow create lasting wealth. So let's talk about what actually works. Let's talk about the three types of assets I'd buy as Bitcoin collapses. Assets that have created wealth for generations. Assets that will continue creating wealth long after cryptocurrency is forgotten. Assets based on productivity rather than speculation. Assets that work. The first asset type I'd buy, the asset I've built my entire fortune on, is businesses. Specifically, shares in quality businesses trading at reasonable prices. This is the core of everything I've done at Berkshire Hathaway. This is what's created enormous wealth for our shareholders. This is what works consistently, reliably across decades and different economic environments. When I say businesses, I don't mean any businesses. I don't mean startups hoping to disrupt industries. I don't mean companies burning cash with promises of future profitability. I don't mean businesses I don't understand or that operate in industries changing too rapidly to predict. I mean quality businesses. Businesses with specific characteristics that make them excellent long-term investments. Let me be precise about what I look for because these criteria are crucial. First, I want businesses I can understand. This seems obvious, but it's violated constantly. People buy shares in companies they don't understand because someone told them to. because the stock is going up, because the story sounds exciting. I don't do that. I only invest in businesses where I genuinely understand how they make money, what their competitive position is, and what their prospects are. This principle of staying within my circle of competence has saved me from countless mistakes. I passed on Google in its early days. I missed Amazon. I never invested in Microsoft until recently. Did I miss opportunities? Absolutely. But I also avoided disasters by not investing in businesses I didn't understand. The technology sector moves quickly. Business models change. Competitive advantages erode rapidly. I couldn't evaluate those companies with confidence, so I didn't invest. Better to miss an opportunity than to lose money on something you don't understand. My circle of competence includes businesses that are relatively stable: insurance, banking, consumer products, utilities, railroads, manufacturing. These industries change slowly enough that I can make reasonable predictions about the future. I can evaluate competitive positions. I can assess whether advantages will last. This doesn't mean I only buy boring companies. It means I only buy companies where I can understand the business model and competitive dynamics well enough to make informed decisions. Second, I look for businesses with durable competitive advantages, what I call economic moats. These are characteristics that protect a business from competition, that allow it to maintain profitability over long periods. Without a moat, competition erodes returns. Rivals enter the market. Prices get competed down. Margins compress. Profitability disappears. But with a strong moat, a business can maintain high returns on capital for decades. What creates a moat? Several things. Brand power is a moat. Coca-Cola has a brand recognized globally. That brand has value. It influences purchasing decisions. It allows premium pricing. It took over a century to build and can't be replicated quickly or cheaply. When you own a business with brand power, you own something rare and valuable. Network effects create moats. American Express benefits from network effects. The more merchants accept American Express, the more valuable the card is to consumers. The more consumers use American Express, the more merchants want to accept it. This reinforcing dynamic creates competitive advantage. New entrants struggle because they don't have the existing network. Switching costs create moats. Banks benefit from switching costs. Once you've set up direct deposit, bill payments, and automatic transfers, switching banks is a hassle. You do it only if you're really unhappy. This stickiness protects market share and allows banks to maintain customer relationships over decades. Economies of scale create moats. Geico benefits from scale. The larger the customer base, the lower the cost per customer to advertise, to process claims, to operate. This cost advantage allows Geico to offer lower prices, which attracts more customers, which increases scale further. Smaller competitors can't match the cost structure. Regulatory advantages create moats. Utilities are regulated monopolies. They serve defined territories. Competition is limited by law. Returns are regulated, but stability is high. Nobody can enter your territory and compete. That protection creates reliable, predictable profits. These moats, these competitive advantages, are what separate great businesses from mediocre ones. A great business with a strong moat can compound returns for shareholders over decades. A mediocre business without a moat struggles constantly with competition and generates poor returns. I look for the moats. I evaluate their strength. I assess their durability. And I only invest when I'm confident the moat will last. Third, I want businesses with consistent, predictable earnings. I'm not looking for home runs. I'm not trying to find the next 10-bagger. I want businesses that make money year after year, through recessions and expansions, through good times and bad. Businesses where I can reasonably predict what earnings will look like 5 years from now, 10 years from now. This predictability is enormously valuable. It reduces risk. It allows confident valuation. It enables long-term holding. When earnings are consistent, you can buy and hold without constantly worrying about whether the business model still works. You collect dividends. You watch earnings grow slowly. You let compound interest do its work. See's Candies, which Berkshire bought in 1970, 2 for $25 million, exemplifies this. See's makes candy. It's been making candy for over 100 years. The business model is simple. Buy ingredients, make candy, sell it. Every year, See's makes money. Every year, earnings are predictable. There are no surprises, no disruptions, just consistent, reliable profits. Over the decades we've owned it, See's has generated over $2 billion in cash for Berkshire. That's the power of consistent earnings compounding over time. Fourth, I evaluate management carefully. Management matters enormously. The same business can perform very differently under different management. I look for managers who are competent, honest, and aligned with shareholder interests. Managers who think long-term, who allocate capital well, who are conservative in their accounting, who communicate clearly, who admit mistakes, who act as stewards of shareholder capital rather than empire builders enriching themselves. I've learned over decades that management quality reveals itself in subtle ways. How they discuss challenges in annual reports, whether they take responsibility for failures or blame external factors, how they compensate themselves relative to company performance, whether they buy back shares when prices are high or low, whether they pursue acquisitions that make strategic sense or simply increase company size. These signals tell you whether management is trustworthy. At Berkshire, we've been fortunate to work with exceptional managers, people who run our operating companies with integrity and competence, people who stay for decades, people who build businesses rather than extract value. This quality of management is a huge reason for Berkshire's success. We buy good businesses, we install or retain excellent managers, and we leave them alone to do what they do best. Fifth, I pay reasonable prices. This is absolutely crucial. Even a wonderful business is a poor investment if you overpay. Price matters. It matters more than most people realize, because the price you pay determines your return. If you pay too much, even a great business will generate mediocre returns. If you pay a fair price for a good business, you'll do well. If you pay a bargain price for a decent business, you might do very well indeed. I want a margin of safety. I want to buy dollars of value for 50 cents. I want room for error, because I will be wrong sometimes. My estimates will be off. Unexpected things will happen. The margin of safety protects me when I'm wrong. It means that even if the business performs worse than expected, I can still make money, or at least not lose much. This discipline of paying reasonable prices requires patience. It requires saying no to most opportunities. It requires waiting for the right pitch. I've said many times that investing is like baseball, where there are no called strikes. You can wait for the perfect pitch. You don't have to swing at everything. The discipline to wait for opportunities that meet all your criteria, including reasonable price, is what separates good investors from poor ones. Let me give you concrete examples of the kinds of businesses I'd buy right now. These aren't specific recommendations because I don't know your financial situation, your risk tolerance, or your knowledge base, but they illustrate the principles I've described. I love consumer brands with pricing power. Companies like Coca-Cola, Kraft Heinz, Procter & Gamble. These businesses sell products people buy repeatedly. The brands are well established. The distribution networks are extensive. The business models are simple and predictable. When you own shares in these companies, you're participating in millions of daily transactions. Billions of people consuming products. That aggregate economic activity creates value that flows to shareholders through dividends and retained earnings. I love financial services companies with strong competitive positions. Banks, insurance companies, credit card networks. Finance is the circulatory system of the economy. These businesses facilitate economic activity. They make money on the spread between what they pay for money and what they earn on it. When run conservatively, with good risk management, these businesses generate excellent returns. Berkshire owns several large financial services businesses, and they've been tremendously valuable. I love utilities and energy infrastructure. People need electricity. They need natural gas. They need water. These needs don't disappear during recessions. They're stable, predictable, essential. Utilities are regulated monopolies with predictable returns. They're boring. Nobody gets excited about utility stocks, but boring works, boring compounds, boring builds wealth. I love railroads. Berkshire owns BNSF, one of the largest railroads in North America. Railroads are essential infrastructure. They move goods across the continent. Trucks can't compete for long hauls. The tracks are already built. The routes are established. It's a mature business with stable economics. Every time goods move by rail, BNSF makes money. That adds up to billions in annual earnings. I love certain retailers with strong competitive positions. Costco is a business I admire greatly. Their model of low prices, limited selection, and membership fees creates a virtuous cycle. They provide genuine value to customers. The membership model creates recurring revenue and customer loyalty. The business compounds nicely over time. I love insurance, obviously. Berkshire's insurance operations have been foundational to our success. Insurance provides float money we hold temporarily and can invest. If you underwrite carefully, you profit from underwriting, and you profit from investing the float. It's a wonderful business model that compounds beautifully over decades. What I avoid in businesses is speculation. I don't buy companies hoping to flip them quickly. I don't chase hot sectors. I don't invest in businesses undergoing rapid change where outcomes are highly uncertain. I don't buy unprofitable companies burning cash with promises of future dominance. These strategies might work sometimes, but they're not investing. They're speculating. And speculation over time destroys more wealth than it creates. The beautiful thing about owning quality businesses is that it's the complete opposite of what Bitcoin offered. Bitcoin was intangible code. Businesses are real companies with real assets, real employees, real customers. Bitcoin produced nothing. Businesses create products and services. Bitcoin's value is entirely dependent on sentiment. Business value is tied to earnings and cash flows. Bitcoin required constant faith. Businesses work whether you're paying attention or not. Let me talk about current opportunities because Bitcoin's collapse is creating some interesting dynamics in markets. Money that was trapped in cryptocurrency speculation is being freed. Some of it will flow into productive investments. Some people are learning finally that owning real businesses beats speculating in digital tokens. This shift creates opportunities. Additionally, the speculative frenzy in cryptocurrency pulled money away from traditional investments. Some quality businesses were ignored because everyone was focused on crypto. Now that the mania is ending, attention is returning to fundamentals, to earnings, to cash flows, to real value. This return to rationality benefits patient investors who never left those principles. I'm not saying markets are cheap right now. I'm not making a market timing call. Quality businesses at reasonable prices are usually available if you're patient and disciplined, but the psychological shift away from speculation, the painful lessons being learned by cryptocurrency speculators, the recognition that real value comes from productivity rather than price appreciation, all of these create a better environment for patient, value-focused investors. When you buy shares in quality businesses, you're not trying to predict what the stock price will do tomorrow, next week, or next month. You're becoming a part owner of productive enterprises. You're entitled to your share of the earnings those enterprises generate. Over time, as those businesses grow earnings, as they pay dividends, as they compound their value, your wealth increases. Not because you found someone to pay more for your shares, but because the businesses you own created value. This approach requires a different mindset than speculation. It requires thinking like a business owner rather than a trader. It requires patience. It requires focusing on business fundamentals rather than price movements. It requires ignoring market noise and staying focused on what matters. But it works. It's worked for me for 70 years. It's worked for countless other investors who followed similar principles, and it will continue working for generations to come. The second asset type I'd buy is real estate, specifically productive real estate, farmland, apartment buildings, commercial properties, real estate that generates income, real estate that serves real lasting needs, real estate that will be valuable decades from now because the underlying use case persists and strengthens. I bought my first real estate investment when I was 14 years old, a small farm in Nebraska, 40 acres. Cost me $1,200, money I'd saved from delivering newspapers, selling golf balls, and various other entrepreneurial activities. That farm wasn't complicated. It grew crops. I rented it to a farmer who worked the land and shared the proceeds. It was productive. It generated income, and I understood exactly what I owned. That investment taught me several crucial lessons about real estate that have stayed with me for 80 years. First, real estate is tangible. I could visit that farm, walk the fields, see the crops growing, touch the soil. There was no mystery about what I owned, no complicated technology to understand, no trust required in code or algorithms, just land, crops, and the fundamental productivity of agriculture. This tangibility provides both psychological comfort and practical clarity. When you own farmland, you know exactly what you have. When you own an apartment building, you can visit it, walk through the units, talk to tenants, inspect the property. This direct knowledge is valuable. It grounds your investment in physical reality rather than abstract concepts. Second, productive real estate generates income. That farm produced crops every year: corn, soybeans, wheat. The farmer sold them and paid me my share. That income was real, tangible, predictable. It didn't depend on finding someone to buy the farm from me. It came from the land's productivity, from the value created by agriculture. This income characteristic is what separates productive real estate from speculative real estate. Productive real estate works for you. It generates cash flows. Those cash flows provide returns regardless of whether the property appreciates. You're not dependent on price appreciation. You're not dependent on finding a buyer. The asset itself creates value through its use. Apartment buildings generate rental income. Every month, tenants pay rent. That rental income flows to you as the owner, minus expenses for maintenance, property taxes, insurance, and management. But the net income is real. It's cash you can spend, reinvest, or save. The building produces that income month after month, year after year by providing something people need. Shelter, commercial properties generate lease income. Businesses rent office space, retail space, warehouse space. They sign multi-year leases. They pay rent monthly. That rental income is predictable, especially with quality tenants and long lease terms. The property produces income by serving a business need. Farmland generates crop income or lease payments from farmers. Agricultural land produces food, feed, fiber, and fuel. That productivity has value. Farmers pay to access that productivity. The land generates income by serving one of humanity's most fundamental needs, food production. Third, real estate provides inflation protection. This is valuable over long time periods. As the general price level rises, as the cost of everything increases, so do rents, crop prices, and property values. Real estate is a real asset. Its value is tied to its productivity and utility, both of which tend to rise with inflation. That farm I bought in 1942 for $1,200, similar farmland in that area today sells for hundreds of thousands of dollars. Some of that appreciation is inflation. The dollars are worth less. But some is also genuine productivity improvement. Better seeds, better farming techniques, better equipment. The land produces more per acre than it did 80 years ago. And the market prices reflect that increased productivity. Apartment buildings appreciate with inflation because rents rise. As wages increase, as the cost of living rises, landlords can charge higher rents. The building's income rises. And as the income rises, the property value rises. A building producing $50,000 in net income is worth more than a building producing $40,000. As rents grow with inflation, values grow too. Fourth, real estate is durable. Farmland doesn't disappear. Location doesn't change. Yes, specific properties can lose value if the surrounding area declines. Yes, buildings require maintenance and eventually need major repairs or replacement. But quality real estate in good locations tends to hold value over very long periods. I can visit farmland that's been in families for generations. It's still producing crops, still valuable, still serving the same fundamental purpose it did 100 years ago. That durability is comforting. It provides confidence for long-term holding. You're not betting on a technology that might be obsolete in 5 years. You're owning something that will have value for generations. Now, let me get specific about what kinds of real estate I'd buy, because not all real estate is equal. Some real estate is speculation, some is productive investment. The difference matters enormously. Farmland is excellent if you understand agriculture and buy in productive regions. Good farmland in Iowa, Nebraska, Illinois, or California produces valuable crops year after year. The productivity can be measured in bushels per acre. The income can be projected based on crop prices and yields. The investment thesis is simple. People need food. This land produces food. Therefore, this land has value. What I look for in farmland is productivity and location, productive soil that yields good crops, access to water, reasonable climate, proximity to markets or transportation. These fundamentals determine agricultural productivity and therefore value. I avoid marginal farmland that barely produces. I avoid areas with water problems or climate issues. I focus on the fundamentals that determine long-term productivity. Apartment buildings are attractive in growing areas with good demographics. People need housing, they'll pay for it. An apartment building in a growing city with employment opportunities and reasonable rents will generate income for decades. The key is location, quality, and management. I look for apartment buildings in areas with job growth because employment drives housing demand. If people are moving to an area for work, they need places to live. I look for areas with reasonable rent-to-income ratios. If rents are too high relative to incomes, occupancy becomes unstable. Tenants struggle to pay. Vacancies increase. But in areas where rents are reasonable, occupancy stays high and income remains stable. I look for well-maintained buildings, buildings that have been cared for, buildings that don't require massive immediate investment, buildings with good unit mixes that appeal to the local rental market. I look for professional management or the ability to hire it. Because management matters in real estate. Good management maintains the property, keeps tenants happy, handles problems efficiently, and maximizes income while controlling costs. What I avoid in apartments is speculation, buying in overheated markets, hoping to flip, buying buildings that need extensive renovation with uncertain costs. Buying in areas with weak employment or declining population, buying based on hoped-for rent increases rather than current income. These strategies add risk without adding corresponding return. I prefer boring, stable, predictable apartment buildings that generate income year after year. Commercial real estate can be excellent but requires more expertise. Office buildings, retail centers, industrial properties, warehouses. Each type has its own dynamics. Each requires understanding specific market factors. But quality commercial properties in good locations with strong tenants create value over long periods. For office buildings, I want quality tenants with long leases. I want buildings in locations with good access and parking. I want spaces that can accommodate different types of tenants, so if one moves out, releasing isn't too difficult. I want reasonable occupancy rates and market rents. I avoid buildings dependent on a single tenant or buildings in declining office markets. For retail, I want locations with good traffic and demographics. I want anchor tenants that drive foot traffic. I want lease structures that include percentage rent so income grows if tenant sales grow. I avoid dying malls and locations being disrupted by online retail. The retail apocalypse has created opportunities for patient investors, but you have to be very selective. Some retail is finished, other retail is thriving. Distinguishing between them requires careful analysis. For industrial and warehouse properties, I want modern facilities in good locations with reasonable access to transportation. The growth of e-commerce has driven enormous demand for warehouse space. Distribution centers near population centers are valuable, but you need to understand the local market, tenant quality, and lease terms. Industrial real estate can be excellent, but it requires expertise. What makes all these real estate investments similar is that they're productive. They generate income from serving real needs. housing, office space, retail locations, warehouse capacity. These needs are real. They're lasting. They're not dependent on speculation or trend. People need places to live. Businesses need places to operate. Goods need to be stored and distributed. These fundamentals don't change, and real estate serving these needs has value. Compare this to Bitcoin. Bitcoin generated no income. It served no real need. It just sat in digital wallets doing nothing. The only way to make money was selling to someone else for more. Real estate is the opposite in every way. It's tangible, it produces income, it serves real needs, it provides inflation protection, it's durable. These characteristics make it a real investment rather than speculation. Now let me address something important about real estate investing. Real estate is illiquid. You can't sell a farm or an apartment building instantly the way you can sell a stock. This illiquidity is both a disadvantage and an advantage. The disadvantage is obvious. If you need cash quickly, real estate doesn't help. But the advantage is that illiquidity enforces patience. You can't panic sell. You can't trade constantly. You're forced to buy and hold.